Tax harvesting. It is really important, in addition to distribution strategy and liquidity needs of the client, that you understand all of the different tax wrappers and how to do tax harvesting of the client's retirement accounts. So that's what we're going to go over today. But before I go over what's better to contribute to, a traditional IRA or a Roth IRA, I want to first dive into the different kinds of qualified and non-qualified retirement plans that are used in our industry frequently. So I'm just going to break them down real quick for you. You've probably heard of 401ks. These are retirement plans for for-profit companies. There's 457s, which are supplemental retirement plans for public employees, typically police, firefighters, court reporters, judges, that sort of thing. And 403Bs are going to be qualified retirement plans for teachers, for people in the public service sector, and that I've met everyone from school lunch ladies, janitors, principals, superintendents, directors in schools, all of the different gamut of that whole industry. So all of these are going to be qualified retirement plans. For the most part, they're generally traditional 401k or traditional 403b or 457. Occasionally, and in some districts, they have Roth versions. We're not going to dive too much into that because you'll understand how those work just by hearing about the Roth IRA. So for simplicity's sake, I'm just going to go over on this 100 level course the very basics, and then of course we can have one-on-one conversations, or I'll add detail in the 200 and 300 level courses for this as well. So, for tax harvesting and understanding these different tax qualifications, on the traditional side of the world, these pre-tax money goes into these 401ks, 457s, 403bs. It grows tax deferred. So meaning if you put your money into here on a monthly basis, let's just use an example. Let's put $100 a month into these type of plans, and that $100 a month really only looks like $75 or $80 to the client, because that $100 is going in on a pre-tax basis, whereas if they had received that on their paycheck, the taxes would have been taken out. They would have only gotten that. And so knowing that the money is a little bit different is important. Sometimes people want to contribute a little bit higher dollar amounts to these because they feel like they can afford the 100, so why not put in 125 or 130 and then have that money grow on a pre-tax basis. Once it's growing, so let's use different dollars now. So let's say we're putting in $1,000 a year, and it grew $100 in that year. So basically, in non-qualified retirement accounts, that $100 growth or interest, typically you'd have to pay taxes on that and add it to your income. As long as it's in a qualified plan, like a 401k, 457, 403b, you do not have to pay taxes on the growth on there as long as it stays inside that plan. So as it grows tax deferred, now in retirement, when you pull money out of here, that's when you have to pay the taxes on these type of accounts. They do have different contribution limits, and that changes typically most years. So I'll get you the current 2021 version of what the limits are, and there's different amounts. For everybody under age 50, there's one amount, here it is, and for everybody over age 50, there's a different amount, here it is. And so with those different limits, it's important to know that you get to put that money away on a pre-tax basis. It does lower your taxable liability for that particular year. So as a bigger example, if we have a person earning $100,000 for the year, they put in $20,000 to their qualified 401k or 403b or 457 plan. Now instead of paying taxes as if they earned $100,000, they only have to pay taxes on $80,000. So putting $20,000 into a qualified plan reduces their taxable income, and so they're going to have to pay less taxes. That $20,000, it comes off the top marginal tax bracket, and we'll show you the top marginal tax bracket here. And now you kind of understand why reducing their higher income is super important. Let's talk about for folks that don't have access to these 401ks, 403bs, 457s, if you don't have access to one of those, you can always have an IRA, individual retirement account. And so in an individual retirement account, again, you put money in on a pre-tax basis, it grows tax deferred, and then in retirement, when you pull money out, that's when you'll pay the taxes on this money. But here we have different contribution limits. So for 2021, there's an amount under 50, and then there's an amount over age 50. And with that, you're not able to contribute a whole heck of a lot, over 3 decades. That only equals $180,000 to $210,000, depending on where you are for age with all of that. And so really important that even with growth and interest and everything, the contribution limit on these is kind of low. And so people aren't able to put in large chunks of money into these IRAs. Roth IRAs are going to be a little bit different. Roth IRAs, you put money into them on a post-tax basis, so an after-tax basis. They still grow tax deferred, and then in retirement, you get all of the money, both the principal and the interest, tax-free, which is great. But those have some limitations here too. So for all of these that I've been talking to you about so far, 401k, 457, 403b, IRA, and Roth account, you can't take money out of them or you will face a 10% penalty. So age 59 and a half is the current rule on when you have to wait until then. Otherwise, if you take money out of these accounts, you'll pay that 10% penalty on top of having to pay taxes if it's a pre-tax account or any surrender penalties if these were in annuity products. Speaking of that for a minute, in 401ks, you typically do not have annuities. In 457s and 403bs, those specific plans get to pick which companies are the approved vendors, and they can have different companies that are approved there. It's usually very specific, so even though you sell annuities, you may not be able to sell without getting contracted with the right carrier an annuity inside those plans. So we do have to do a little due diligence and research to figure out if you're able to do that. Once you get into a place like a school with a 403b and you've done the research and you figured out that they can contribute to this annuity product and you're very familiar with the annuity product, you can go around and help a lot of people in a specific school or in a specific police station or firehouse to be able to get all of their options here. A lot of the teachers we talk to in 403bs, they're more conservative by nature. So fixed indexed annuities can be a good option to give them some upside potential and protect the downside and have that guarantee they can't be losing money inside of there when their friends are just in the market with a different type of product. So that's important to know there as well. There are some other types of qualified retirement plans, or non-qualified, I guess I should say, and I want to chat about those here for you as well so you kind of understand the basics here. So usually 401ks are great because the employer is providing a match. So a match is going to be something like 3% of someone's salary. So if they earn $100,000 and they put in $3,000 over the course of the year, or just $250 a month, and the employer might do the same thing and they'll match that $250 a month. So now you have the full $6,000 per year going into that type of account. Of course, you can contribute more, but there's a good benefit for getting that initial match. After that, it's really all about, there's nothing better than that free money. So after that, there's kind of some differentiations you have to make here on what their best strategy is going forward. And we're about to get to that main question, what's better to contribute pre-tax or post-tax accounts here. So with that, I do want to point out Index Universal Life Insurance, and just real briefly here because we're not on the life insurance section, but the important thing to know is they're a little bit different than the rest of these qualified plans. While they still give the client tax deferral, which is the main thing with all of those plans. Here it's kind of like a Roth where you contribute after-tax dollars. The money inside there grows tax deferred, so it's great. But here you don't have those limitations like a Roth IRA would. So if someone wants to contribute $1,000 a month or $3,000 a month into an IUL, they absolutely can. Of course, you're going to want to make sure that they're overfunding this appropriately, that they did have a true need for a death benefit because this is overall a life insurance product, and there's some other important factors there as well that we can of course dig into on a one-on-one basis, or we can try to get a little bit more detail out of these in the higher level courses here for you. So I just wanted to make a quick point on IULs because you can contribute however much you want to. You can also retire early. So I talk to a lot of people that want to retire a little bit early, age 50. And so if they have all their money locked up in a 401k or locked up in an IRA or a Roth IRA, they can't touch that money until 59 and a half, or they face a 10% penalty and then potentially all of the tax ramifications of that as well. On an IUL, they can contribute much more to it. They get that same tax deferral, and then they can take money out of there at age 50 or whatever age they're comfortable with, assuming the surrender period is over on that IUL. So those can be a great place to put some after-tax money, but of course they're not a good fit for people that are not good health rating with the life insurance company. So for the people that use tobacco, are significantly overweight, or have lots of medical conditions, we typically don't recommend those IULs because the internal cost of insurance is too high for the cash value to do anything good. So again, that's a little in-depth for all of that, but I want you to understand those are a place where people can contribute money to as well. And then finally here, it's just a non-qualified investment account. And so how a non-qualified investment account, it works, is people get their paycheck, so they've already paid the taxes on it because it went through their payroll and payroll took out their taxes. So now they're putting money in on an after-tax basis. Unless it's inside of an annuity, they're not going to get tax deferral. So if this is just straight securities, mutual funds, goes up with the market, goes down with the market type of a thing, then when it does have growth, they are going to have to pay the taxes on that growth there. When it's wrapped up in an annuity, the annuity is the vehicle that gives them the tax deferral here. Typically, these tax wrappers are the reason they get tax deferral, but in non-qualified accounts, annuities are the reason they get some tax deferral there. So continuing on with that line of thought, they put money in on an after-tax basis, they get the tax deferral, and then in retirement or when they end the annuity and need to pull money out of there, that's when they have to pay taxes on these type of accounts. So those are the different tax qualifications. Again, important to kind of understand how they put money in, how they take money out, and the best scenario for them. So now the main question I always get is it better to contribute to a traditional IRA or a Roth IRA, or a traditional 401k or a Roth 401k? And the answer lies simply based on their income, because it's all up to their tax bracket. If they're at a super high tax bracket and husband makes $100,000, wife makes $100,000, jointly they're making $200,000, they're at a pretty high marginal tax bracket according to the marginal tax bracket here. And the best thing for them to do, if we've already mapped out their cash flow and said they're going to go from $200,000 to guaranteed income in retirement at age 65 based on Social Security and pensions of only $60,000, when they go from $200,000 to $60,000, they're at a much lower tax bracket, and that's really important to know. So if we can lower their taxes when they're at $200,000, even if we increase them a little bit down the road, we're going to do a lot of good for that client, because we're reducing their $200,000 all the way down to, if they put in $20,000 each on these 401ks, these pre-tax 401ks, we're going down to $160,000. So we've taken $40,000 off of their top marginal tax bracket. Here, of course, when they pull money out in retirement and we take it out slowly, we're only increasing their taxable liability by the amount that they take out plus their incomes already. So if they have part-time jobs or if they have Social Security or pension, those are the details that matter. And so for cash flow planning, typically understanding that people with higher incomes, it's going to be more appropriate to contribute to pre-tax accounts to lower their current year taxable liability. Now, it's a little bit better for lower income folks, people that are making $20,000 or $30,000 that aren't super high on the marginal tax bracket scale, to say, okay, you know, it's not really going to help me if I put money into a pre-tax account this year very much at all, so I'm going to do a Roth account, Roth 401k, Roth IRA, whatever they have access to, and put money away on a post-tax basis. It grows tax deferred. And then in retirement, most people that have had a low income their whole life are probably still also going to have a low income in retirement, and so when they take money out, it's not going to increase their marginal tax bracket very much at all, and it's only on those couple of dollars that they need in retirement, but then it's all going to be tax-free. A couple other important points as people are getting close to retirement to know is that if you are ending your employment mid-year, so in June, and you had big high salaries, and you and your wife are earning $100,000 a year, so we worked half the year, so in total we've earned $100,000. Right now is not the best time to take money out of pre-tax accounts because you've earned $100,000 for the year, so everything that you take out of pre-tax accounts is going to increase your taxable liability. Here, you want to take money out of post-tax accounts and say, oh, we've only made $100,000 this year, as opposed to taking another 20 out of a 401k or a traditional 401k and saying, oh, now we have to pay taxes on 120. Here we'll pull the 20 if that's what they need from their Roth account to make sure we're not increasing their liability for that year. And in future years, we can slowly disseminate the dollar amounts that are in those pre-tax accounts. So going back to what's better to contribute to, it's really all about their tax harvesting situation and where they are at income-wise. So if you figure that out, it's pretty easy to say, Mr. and Mrs. Client, you're making a lot of money, you're doing a really well job. In retirement, you're not going to have this high taxable income anymore. So what we should do is reduce your current year taxable liability to the best of our ability, so as much as you can afford to put in an account like that. And then in retirement, we'll take a little bit higher income as we need to. That's the best thing for you guys. Versus if you're meeting Mr. and Mrs. Client that are only making $20,000 each, then you can say with confidence it's better for you guys to be contributing to these Roth accounts or these IULs, basically putting something away after tax dollars because you don't need the tax help this particular tax year. And of course, if you guys have done the math, you can kind of understand. You can build up $1 million account in a Roth account, Roth 401k or Roth IRA, and you've got your $1 million there, you're able to spend all of the million. You might be able to build a 401k balance because you're putting in pre-tax money and getting the growth on that to 1.3 million. But of course, when you take money out in retirement, then you only really get to spend about $1 million of that. So financially, it works out the same either which way. The big difference is all about the tax bracket that the consumer is in now and will be in later in the future. Of course, we can't predict all of the future stuff because Congress will change this tax code between now and the next 30 years. But we have to do the best planning with the tools and resources and the education that we have now. So that's how to figure out what's better to contribute to. In retirement, when we're pulling money out of different accounts, we're very closely managing the client's taxable income for a couple of reasons. One, it'll matter for Social Security and whether they have to pay taxes on that. Two, it'll matter for their health care, especially between the ages of 55 and 65, if they're on or if they're ending their employer coverage health insurance and needing some type of Affordable Care Act. If we can get their income lower, even if they have $1 million worth of assets, if they're taking out of Roth accounts or non-qualified accounts or IULs, it's not going to increase their taxable liability. So very specifically for health insurance, we want to make sure from age 55 to 65, we're not increasing their taxable liability because we want it as low as possible. That's how they're going to get the most premium tax credits out of those health insurance plans here currently. So a lot of these different concepts integrate in an overall financial plan for the client. And when you can say, we've put this plan together, this is how you're going to contribute to accounts between now and retirement, and in retirement, these are the priority order in which you will take money out of these accounts. One, to keep in mind your distribution strategy to make sure we're always taking money out of an account when it's up or at least not down. And then two, this tax harvesting situation to keep in mind your health insurance and everything on that nature. But we also need to keep in mind your liquidity concerns. So I want to chat with you for a second about those liquidity concerns. Basically, we have to figure out cash flow wise and net worth wise everything that's going on in the client's life. So when they're planning on taking money out, what they plan to take the money out for, and we need to make sure that we've got enough money and enough liquidity to be able to do that. So if they've got $1 million and they are going to need $150,000 to pay off their house and another $30,000 to pay off their car loans, and that's what they want to do is take out $180,000, and they're not listening to us about tax consequences, or maybe they don't matter for whatever reason to the clients, and they're going to take this money out, and we put $1 million into a fixed indexed annuity that only has 5 or 10%, that's not going to be enough money for the client. And so very specifically, we either have to put them in some type of product that is going to allow for that much liquidity, or we need to portion off some of that money and put it in a securities licensed product, or something where the client has access to all of the money they need in any given year and have an emergency fund in addition to all of that. So making sure that we have liquidity concerns covered for the client is absolutely paramount. You never want the call from the client a year or 2 or 3 after that you've sold one of these products to say, hey, I need a little bit extra money. Can you send me over 20% of my account? And I want to do this and that and go on a vacation, buy a house in Florida and do all of these different things. You want to be in the position of, we've talked about this, we've set aside money, we have the liquidity that you need. That's the kind of call you want. You don't want them to say, oh, remember we put this in a long-term investment, you can only take out 10%, otherwise you're going to be whacked with this big surrender penalty, plus any penalties if they're not 59.5 yet, and go down that rabbit hole. So it's really important that we take all of those things into consideration when coming up with their case design, after we've asked all of the right questions in the fact finder. That's why those two things are so important here. So with that said, how annuities fit into these products, 401ks typically do not have annuities, typically just mutual funds and retirement date funds. There's a new rule passed recently where annuities can go in there, but I think that is going to be plan specific, so it's going to be pretty hard to get annuities into a plan if you don't typically sell 401k plans, so I'd scratch that off your 2021 list anyway. 457s and 403bs typically do have annuities inside them. You do have to work with the plan administrator, figure out which companies are allowed in that specific plan, and then go through those companies to actually be able to sell those type of plans. There's a lot more detail in that than just selling an annuity in a 403b. You do have to work with the plan administrator, you do have to work with a payroll processing company to get the flow started. So there's a couple other pieces to that puzzle. So if you're working in that industry, good idea to have a coach or a mentor that's done that a couple thousand times so that you're doing the right thing for the client, and also you have the ability to do what you want to do in there. For IRAs and Roth, we can fund these with any investment we want, including annuities. So if annuities are your game and that's what fits the client's risk tolerance, yes, it's absolutely appropriate. If they have previous old IRAs or Roth accounts at, I'm picking on Ed Jones, but really there's a ton of different mutual fund brokerage companies out there. So if there's any of those out there, we can roll it over to an annuity and keep that IRA or Roth tax status. So that's very important to know. We can also roll 401ks over, and this is kind of the biggest piece of the puzzle. We can roll the 401ks or 403bs into IRAs. Now there's a lot of different rules surrounding that too. After separation of employment, almost always it's okay to do, but if they're still employed, we typically can't roll the money unless they're age 59, or some plans have you wait until 65, or some plans don't allow you to take money out until they leave service or retire. So important to kind of understand, you may have the ability to move some of it, you may not. We just have to check with that company's HR and figure that detail out. But when we're able to roll these, they typically have, for clients that are ages 45 to 65, a pretty good account balance in these plans, especially if they've worked there quite a while and contributed moderately to these accounts over a long period of time. When we roll these over into, a traditional 401k, or roll over into an IRA, or a Roth 401k, or a Roth 403b, we'll roll over to a Roth IRA. Once we've done that, we can fund that with annuities and our safe money ideas for the clients. Of course, we can keep securities products in there as well, but of course you have to be securities licensed to be able to do that. So that's kind of the differentiator, and I know that was a complex answer for should I contribute to a pre-tax account or a post-tax account, but the answer is real basic. It depends on your income, and it depends on what your cash flow is going to look like now and into retirement of what's best for you. I think it's important that you guys figure out how to take money out of these accounts, what's the best distribution strategy, what's the best tax harvesting strategy. Definitely keep those in mind, and keep the liquidity in mind of the client so that you map all of that out. And when you do a good job of that and say, these are the accounts you're contributing to now, this is my recommendations for your contributions, this is why it's a good idea, and all the way on backwards of how to take money out and why to do that, the clients are rather impressed when you color coordinate the pre-tax and post-tax different accounts and your recommendation of safe money and a little bit riskier money. They really appreciate you going to the lengths of kind of doing all of the planning for them between now and when they die, which is really, really helpful for them. And it's important for you guys to understand where these annuities fit in here as well. So we can fund these IRAs or Roth IRAs at $500 a month for the client, and we can use multiple premium deferred annuities inside of there, and those work out terrifically. There's a couple of good companies that do that. We can roll 401ks over into single premium products and maybe get a little bit higher participation or higher cap rates. We can set up auto draft and monthly enrollments, or we can totally scratch that and just do to one-time lump sums. So there's a lot of different variations in here. And I know this was a quick video on tax harvesting. If you do have any questions or you are still confused, I have a note sheet or a cheat sheet for all of these different qualifications and their limitations and contribution limits and penalties. The last thing I want to chat with you here about is required minimum distributions, RMDs. The rule just got changed this year. It used to be set age 70 and a half. You had to start taking money out of these pre-tax accounts, so traditional 401ks, traditional IRAs, stuff where people haven't paid taxes on yet. They put money in pre-tax, it grew tax deferred, and now they're sitting on the money and growing it. Used to be age 70 and a half, now it's age 72 that you are going to start having to take money out of here and at least pay the taxes on it. You can keep investing the money if you want to, but you at least have to pull it out of that IRA, pay your taxes on it, and then you can reinvest the funds, or you can put that in your checking account and spend those funds, but you are going to have to start taking money out. And the IRS has a mortality table, and it starts at about 3.5%, and it keeps tearing up the percentage that you have to take out of these. And so by the time you're 100, basically all of this money has to be out of there. You have to pay taxes on all of this money. The government wants their taxes. Let's get down to it. That's why they're doing all of this stuff. There's a couple other things to note about those required minimum distributions. Most of the annuities we sell are RMD friendly, even if this percentage of RMD increases above the free withdrawal percentage. Most of them are still friendly with those RMDs, so you don't have to worry too much about that. But then also kind of at the end of life, when we're talking about these tables, there's things that we are going to want to talk to them about on an individual basis about wealth transfer, and that'll be a big conversation and topic as well. So thanks for watching. I'll definitely see you on the next video, and I'll see you at the top.